Welcome to the Mint Funds and Market Update. I'm Kirsten Boldarin, Amplify Group CEO. Please take a minute to note the disclaimer regarding this recording. So December was a modestly positive month for equities, both global and domestic, although over the course of 2025, global equities significantly outperformed domestic equities, and even domestic bonds did better than domestic equities. It is really quite staggering that the New Zealand equity market has only delivered an annualized return of 0.7% over the last 5 years, which is significantly behind even cash. If you contrast this with the long-term annualized return of the NZX 50 of 8.4%, it certainly feels as though we are due some mean reversion. Turning now to broader markets over 2025, following several years of dominant US equity markets, non-US equity markets actually outperformed US markets despite ongoing gains in technology-related stocks. In fact, emerging markets were particularly strong and the best regional performer in 2025. It's fair to say that non-US markets also had a little bit of a boost just from the fact that the US dollar weakened a fair bit over the last year. So in December and now into January as well, we had a bit of a catch-up of data releases. So the US inflation report for November came in softer than expected, with core CPI now sitting at 2.6% year on year, and that's the lowest reading since March. However, a lot of this was due to shelter, which was driven off Bureau of Labour Statistics assumptions, given that the data was missing in October due to the government shutdown. We will get another inflation update today, and this will certainly be closely scrutinized, given that there will be a bit of a catch-up on some of that data. And then turning to the labour market, we had the US JOLTS report for November, which showed ongoing softness in labour demand, with job openings falling by a larger than expected 303,000 to 7.15 million. And in addition, October openings were also revised lower. We spoke about this in prior months too, but it has certainly been perplexing for economists, where we have strong end demand but a weakening labour picture. There have been various explanations, some of which have included the K-shaped economy, so strong demand driven from wealthy, asset-rich consumers who've had the benefit of higher interest rates on their savings, as well as ongoing gains in the stock market, and obviously lower socioeconomic and certainly demographic characteristics of the market struggling much more with those higher interest rates, and also just the affordability impact of that. Other explanations as to why companies have enjoyed strong profits but have been reticent to hire. Some of the explanations that have been given are really around just generalized uncertainty regarding tariffs. It could also be that there's a fair degree of scarring from COVID when employers laid off workers and then really struggled to hire them back again. But of course, one of the key focal points is also the nature of AI and how that might actually be reducing demand for workers whilst still maintaining profits and productivity. We did include last month the Challenger data, which attributed layoffs to different features. So AI attributed layoffs still remained quite low, but it's certainly something to watch going into 2026. It sort of feels that 2026 is likely to be a year when we get more clarity on the underlying dynamics of the market, and we expect labour data to continue to be a focal this year, particularly as it starts to give a little bit more insight into the trajectory of the US economy. We have recently published our 2026 market outlook, and in it we wrestle with the elevated market valuations against what is a reasonably robust economic backdrop. Perhaps the other additional, more constructive piece from an economic standpoint is just the fiscal impulse coming down the pipe in 2026. So we had the One Big Beautiful Bill Act passed last year, and this will reduce individual income taxes for 2025 by an estimated 144 billion. Now, because the IRS did not adjust withholding tables after the law passed, workers generally continue to withhold more taxes from their paychecks. So rather than gradually receiving the benefit of tax cuts through higher take-home pay, most taxpayers will actually receive it all at once when they file their tax returns. So the Tax Foundation estimates that an average tax refund per filer is going to be $3,800 compared to around $3,000 in prior years. And beyond individual tax cuts, the OBBBA changed several business line provisions for 2025, which again should be supportive of economic growth. But then it's also likely that as the president's approval ratings decline and we head into midterms, that there will be more incentive to produce fiscal stimulus and address the affordability crisis. Now, the legality of some of these measures, and you can see some of President Trump's tweets there on the right-hand side, may stall them, but certainly the directionality of them and the intent is clear. What will really be a challenge, in addition to lawsuits, for the Fed is if we see a pickup in inflation and that sort of changes the trajectory of interest rates. If we did start to see that, a pickup in inflation and the expectation that the Fed was likely to actually pause cuts or even reverse them, that would certainly prompt us to move into a much more defensive stance. Turning now to New Zealand, where the economic picture is much clearer and continues to improve, albeit slowly. So the RBNZ's GDP nowcast makes a projection of the next quarter ahead GDP number. So in other words, forecasting from the last data point and uses high frequency indicators to infer GDP in real time. So the actual Q3 GDP number, which was released on the 18th of December, showed strong GDP growth, or stronger than many expected, of 1.1%. And the actual outcome was higher than the nowcast forecast, or the nowcast had been forecasting for that quarter. Currently, the nowcast is forecasting a positive GDP run rate of close to 0.6% quarter on quarter, which would be an improvement on the three-year average GDP number that we've seen, which is really that sort of bumbling along at the bottom, where we've been running at only 0.2% per quarter. So that certainly points to a little bit more of an optimistic view than has been the case currently. And then again, helpfully for New Zealand from a consumption perspective, we are starting to see the flow through of lower interest rates into mortgage rates. And subsequently, that has lent some support to the building and housing industry. And so building consents have started to tick upwards. Home sales still remain quite sluggish, also because we had quite a bit of supply come onto the market, but there are signs of improvement. But what prompted a little bit of concern towards the end of last year was really that the RBNZ's OCR forecast resulted in an increase in wholesale rates, and some banks pushed these through to an increase in mortgage rates. So this resulted in mid-December, new Governor Anna Bremen speaking to the media outside of the regular bank meeting schedule to say that growth seems to be recovering, having stalled in the middle of the year, but that the labour market remains weak, although she expects it will recover with the economy. And she's confident that CPI will decline towards 2% by the middle of 2026. She went on to say that market conditions have tightened since the November decision beyond what is implied by the OCR, and that they are closely monitoring wholesale market interest rates and their impact. So she was certainly trying to push back against the more hawkish market interpretation, and following her comments, wholesale rates subsequently fell. And I guess we will wait to see in February just what sort of tone she takes from a dovish perspective. Moving on to the funds. The Diversified Income Fund fell over the month, and this was really driven by the Australasian equity component of the portfolio. So unlike global markets, where growth stocks have performed quite strongly and cyclicals have been weaker, although we've seen more recently a reversal of some of that. In the sort of New Zealand market, we have seen the opposite. So we've seen a strong rally in cyclical and small cap stocks with sort of more defensive structural growth type stocks underperforming relative to benchmark. And really in simplistic terms, this is probably due to our monetary policy backdrop, where we were earlier to raise rates and now earlier to cut them. So really what prompted that sort of cyclical rally was the 50 basis point cut by the RBNZ in the middle of this year. And generally what performs best in an interest rate cutting environment is cyclicality. But ultimately that usually gives way to an improving medium-term outlook, which tends to favor growth stocks. So if we look forward into the market dynamic for 2026, we expect to see better results from some of those structural growth stories in New Zealand. We did, though, have some gains from Serco, up almost 12% in December, following a solid update from them in November, management update, and the positive momentum of that continued into December. And Napier Port was up almost 7% over the month on the back of strong earnings and a pickup in export volumes. Turning now to the Mint Diversified Growth Fund. We had positive returns from our global equities, but for the reasons we just mentioned, that cyclical versus growth component of the domestic portfolio, we did have some detraction with respect to our Australasian equity allocations. On the global equity side, Comcast delivered positive news with the announcement of the spin-off of its cable networks into a new company. And NVIDIA pushed back against the slightly more negative AI narrative that was beginning to take hold towards the end of the year at the UBS Global Tech and AI Conference, and really reiterated confidence in the transition to accelerated computing. Thank you for listening, and as always, please get in touch should you have any further questions, and best wishes for a prosperous and productive 2026.